You spent decades saving inside your retirement accounts. But here's the gut punch nobody warned you about. The IRS eventually forces you to pull that money out. They're called required minimum distributions, and ignoring them gets brutal fast. Think about it. That tax-deferred 401k, or traditional IRA, grew for years untouched. The government let you skip taxes back then. Now they want their cut, and they won't wait forever. RMDs are how they collect. Most people don't even know this rule exists until it slaps them. Then it's a panic of phone calls, penalties, and a surprise tax bill. You're going to know better, way before it ever happens to you. Here's why this matters more than you think. RMDs don't just cost you a withdrawal. They can spike your tax bracket, tax your Social Security, and quietly raise your Medicare premiums. One rule, 3 hidden hits. Let's get clear on which accounts trigger this. Traditional IRAs, SEP and simple IRAs, and most workplace plans, your 401k and 403b. Anything where you deferred the tax going in, the IRS comes calling later. But here's the beautiful exception. Roth IRAs have no required distributions for the original owner. You already paid the tax, so the IRS leaves you alone. That money can grow untouched for your entire life. And it gets better. Thanks to a law called Secure 2.0, Roth 401k accounts no longer force withdrawals during your lifetime either. So Roth money, across the board, stays yours on your terms. Remember that advantage. Now the big question, when does the clock start? Under current rules, your RMDs begin at age 73. And here's the kicker, that start age is set to climb to 75 by the year 2033. The runway keeps shifting. There's a sneaky timing trap here. You can delay your very first RMD all the way to April 1st of the next year. Sounds nice, right? But then you're forced to take 2 distributions in 1 year. Double the tax hit. So how much do they make you withdraw? The math is simpler than you'd guess. You take your account balance from December 31st of last year, then divide it by a number from an IRS life expectancy table. That table is called the Uniform Lifetime Table. The older you get, the smaller the divisor, which means the bigger the percentage you're forced to pull out. Your required slice grows a little larger every single year. One detail that trips people up. If you have several IRAs, you can add them together and take the total RMD from just one. But 401k accounts, generally, each one needs its own separate calculation and its own withdrawal. Here's a quick example so it clicks. Say you're 73 with 500,000 saved. The table factor is roughly 26.5. Divide, and you must withdraw close to $19,000 that year. Just an example. Now pay close attention, because this part is where people get destroyed. If you miss an RMD, the penalty used to be a savage 50% of the amount you failed to take out. 50%. The good news? Secure 2.0 softened that blow. The penalty dropped to 25% of the shortfall. And if you fix the mistake promptly and file the right form, it can fall all the way to just 10%. But don't get comfortable. Even 10% is a painful, totally avoidable loss. This is free money you're handing the IRS for nothing more than a missed deadline. There is no excuse to ever let it happen. Let's talk about the part that stings beyond the penalty. Every dollar of your RMD gets taxed as ordinary income. That's the same rate as a paycheck, not the lower rates you'd hope for on investments. And because it's added on top of your other income, a large RMD can shove you into a higher tax bracket. Suddenly, you owe more on a lot more of your money than you ever planned for. It doesn't stop there. Higher income from RMDs can make more of your Social Security benefits taxable. The very money you earned all your life gets taxed twice over. Many retirees never see this coming. And the last hidden hit, Medicare. There's a surcharge called IRMAA that raises your premiums when your income climbs. A big RMD can quietly trigger it, costing you hundreds or thousands more in healthcare every year. Okay, enough doom. So how do you actually beat this? You can't dodge RMDs entirely, but you absolutely can shrink them and soften their bite, if you plan ahead. Here are the moves that work. Move number 1, Roth conversions. In your 60s, before RMDs even begin, you can move money from your traditional IRA into a Roth. You pay tax now, but that balance never triggers a future required distribution. Why does this work so well?
Your 60s are often a low-income window, after the paycheck stops, but before RMDs and Social Security pile up. You convert at a low tax rate now to avoid a forced high rate later.
Move number 2 is a quiet superpower, the Qualified Charitable Distribution, or QCD. If you give to charity anyway, you can send money straight from your IRA to the charity, and it satisfies your RMD tax-free. Let that sink in. A QCD lets you check off your required withdrawal without adding a single dollar to your taxable income. For the charitably minded, it's one of the most powerful retirement tax tricks that exists. Move number 3, withdraw strategically and early. You don't have to wait for the IRS deadline. Drawing down some of that tax-deferred money in your lower income years can flatten those giant future RMDs before they ever form. Now, let's turn knowledge into action. This week, find out exactly which of your accounts will trigger RMDs and at what age yours begin. Write it down. You can't plan for a deadline you've never actually pinned to a date. Next, set up automatic RMD withdrawals with your account provider. Almost every brokerage offers it. Switch it on, and the right amount goes out before December 31st every year. No missed deadline, no brutal penalty, ever. Then, if you're in your 60s, run the numbers on a Roth conversion this year. Even converting a small chunk now can save you a fortune in forced taxes down the road. Don't leave that window wasted. And if you're charitable, ask your IRA custodian about setting up a QCD before year-end. One phone call can turn a taxable obligation into a tax-free gift. That's the kind of win that pays you back twice. Honestly, the smartest move of all is to loop in a tax professional before the year you turn 73. The right plan, built early, can save you tens of thousands across your whole retirement. It pays for itself. Here's your permission to breathe. RMDs feel scary because they're mandatory and the penalty is harsh. But the rule itself is simple, and the strategies are right here. Knowledge turns this from a threat into just another step. You did the hard part already. You saved. You built the nest egg. Now you just have to manage the exits smartly so the IRS gets its fair share and not $1 more than the law requires. Every retiree who plans ahead keeps more of what they earned. The ones who ignore RMDs hand over penalties and surprise taxes for no reason. You get to choose which kind of retiree you become. Choose the smart one. Let's lock in the key points. 1. RMDs are forced withdrawals from tax-deferred accounts, starting at age 73. 2. Roth accounts escape them for the original owner. Those two facts alone put you ahead of most people. 3. The math is your balance divided by an IRS factor, and the penalty for missing it is severe, so never skip it. 4. RMDs hit your taxes, your Social Security, and your Medicare. Stack all 4 in your mind. And 5, the big one. You fight back with Roth conversions in your 60s, with tax-free QCDs to charity, with early strategic withdrawals, and with automatic distributions, so you never miss the deadline. Plan early, win big. One more time, because it's worth it. The deadline is December 31st every year. The start age is 73, rising to 75. Roth is your friend, and a single year of planning can protect decades of savings. So tell me in the comments, are you planning Roth conversions before RMDs hit, or is this all new to you? If this helped, hit like, subscribe for one simple money lesson at a time, and share it with a friend.